Hello and welcome to this brand new edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis, deep dive into the financials and tell you about the key risks and triggers going forward. So let's not waste any time and get to our first stock today. My colleague Nigel traveled to Hyderabad to get chatting with the management of Rainbow Children's Medicare and gets us this very special deep dive.
Good to meet you, Dr. Ramesh. Absolute pleasure.
Yeah, good morning. Welcome to the world of children's healthcare.
Absolutely. Come. Well, Inside Out on the Road has traveled to Hyderabad and we're at Rainbow Children's Medicare. As the name suggests, it's a multi-specialty pediatric hospital chain, with close to around 30% of their revenues coming in from women's care, while 70% comes in from pediatric care. They deal with pediatric ICU, pediatric tertiary and quaternary care. Well, their women's care includes hysterectomy and laparoscopy. Their pediatric care includes preborn babies, transplant of liver, kidney and bone marrow transplant. Well, it's a new kid on the block. It listed in 2022. They raised close to 1,580 crore rupees. 280 crores of that was a fresh issue, so the money flowed back to the company. While the remainder was money taken off the table by the promoter entity as well as CDC. A few specifics should come up for you. They have close to 1,600 operational beds, 15 hospitals, 640 doctors, and they delivered more than 12,500 babies in the past year and admitted more than 10,000 ICU patients. The geographic breakup as well comes up for you. And they're mostly focused in South India, with Hyderabad accounting for close to around 50% of their capacity. The occupancy level in the past year was around 45%. But what works for them is they break even at lower occupancy. That's close to around 35%. An adult hospital, remember, breaks even at around 50%. Their Capex per bed as well is far lower. It's at around 50 to around 60 lakhs, which is much lower than adult hospital. The average revenue per bed in the past year, which was a COVID hit year, was around 51,500 rupees. That had a bit of a bump up because of the COVID vaccine revenues. Well, the average length of the stay as well in the hospital has been steady at around 3 days odd. Well, to run you through the IPO price and the price movement, well, it listed and the stock got a bit of a knock. And it went down close to 25% post the listing. But from there, the stock has given you a 50% return. And now it's hovering around the 52-week high. Well, for the past year, they delivered revenues of around 975 crores with margins of around 32%. The ROC and ROE has been in the mid-20s. Balance sheet is solid with close to around 400 crores of cash in books, which means that is close to around 8% of their current market cap. But they have plans to scale capacity from around 1,600 beds all the way to around 2,500 beds. On the valuation front, it trades at a bit of a discount in comparison to its larger peers at around 17 times EV on EBITDA. But to understand more about the company's plans and how they want to expand from here, what's the outlook on occupancies, all that and more, well, we are joined by the promoter MD and chairman of the company, Dr. Ramesh. Well, Dr. Ramesh, we have been to many hospitals and many adult hospitals, but you must be having your own set of challenges, right? What are the behavioral changes that you observe in your co-hospitals? That's, pediatric as well as maternity hospitals. Could you give us a sense on that front?
The Nigel children's hospitals are very, very different when you look at the healthcare model. So generally, children's hospitals have got a very different fundamentals altogether. Because children's hospitals always have to be a kind of it's a multidisciplinary. Because in adult hospital, it's more of wear and tear. People come with a cardiac problem, neurology, nephrology. Children often comes as an emergency into the emergency department as a sick child.
Yes.
So you do not know what is exactly specific problem. So people have to work together. It's a collaborative approach rather than a one doctor approach.
Okay, all right. So we've got a sense about the industry, and the way you function. What is the growth that you're looking at in your core business? That's point number one. It'll obviously outbeat the growth of the system, of the entire industry. And with that sort of a backdrop, tell us, you must be having a goal. You've constantly be outgrowing the market. Do you expect to continue doing that?
Overall, the maternity and pediatric markets have grown significantly. Yeah.
Yes.
So when you compare the adult market today, the pediatric market is growing at a 14% CAGR, and obstetrics, which is maternity, growing at a 12% CAGR,
All right.
as opposed to 80% of the adult multi-specialty care.
Right.
And when you kind of look at where we are growing, the last 10 years, we've been growing at the rate of 18 to 20%.
Okay.
What we expected to grow is about 18%.
Okay.
Compared to the market.
Well, Dr. Ramesh, international business for as a percentage of your revenues is only, I think, around 1 to around 2% odd. But the big focus has been on medical tourism.
Yeah.
So that's sort of a backdrop. I wanted to ask you, do you believe India can be a hub, where overseas patients come out here and they get treated? Children, women care as well can be done. Give us a sense about the industry and the opportunity for you. From the low single digits, where does that number go to?
We are just kind of started our journey as a multi-specialty and quaternary care services. So as on today, that we just do about 2% of the business is international.
From around 2%, where does that number go? Say in the next 4 to 5 years, where do you see that number headed?
I think we'll probably kind of go to 5 to 6%.
5 to 6%. A couple of other differentiating factors between your hospital chain, besides it being specialty, is the Capex cost, right? The total cost of setting up a bed. I believe it's much lower than an adult hospital, which makes you stand out. And also you break even at a lower occupancy levels. So take us through both those two data points.
So what we do is, especially Rainbow, we have taken a route of a satellite model, which means we need to be the very accessible part of the city. Generally, the real estate cost is pretty high.
Right.
So to buy a land and build it, so therefore we have taken a satellite model.
Okay.
So we spend about 60 lakh rupees so far. The track record been per bed as a satellite model. So which is kind of we break even around 35% of occupancies.
So how much cheaper are you all in terms of a cost per bed?
I think 30%.
30% cheaper. And the break-even point for you all is what, in the 30s?
I think 35% of occupancies.
You have recently commissioned a Chennai facility, right? A new Chennai hospital, which has added quite a few beds. I think 50 to around 100 beds, or is what it's added as of now. By when does that, that unit break even? If you could give us a sense in terms of a timeline.
We entered in Chennai for about 3 years ago with a hub hospital. Now this is a spoke hospital. So our hub itself is broken even in 2.5 years time. I would expect it to be a kind of a 1.5 year, the spoke hospital to do well, because it is in the area where there's a lot of young population.
What are the rough occupancy numbers you're looking at? The last few years, well, it's been a little bit up and down. It's been a little bit varied because of COVID.
Yeah.
But going ahead, what is the steady state occupancy number that you're looking at? And also the ARPOB, that's the average revenue per bed.
Yeah.
How does that number move up from here on? Go ahead, sir.
Okay. So you're right, Nigel. We have actually taken a huge hit because of the pandemic.
Yes.
Pandemic time, children actually stayed at home. So fortunately, COVID has not been a serious illness for the children. So
right.
Our occupancies have really plummeted to 34, last year about 45%. So we're coming back in a big way. This year what we see is the normal year. And also the pronounced normal illnesses also in increasing number of outpatients we have started seeing this year. So we'll get back to the occupancies about 55 to 56%,
okay,
which is a pre-pandemic.
Right.
So in a steady state, what we do is about adding the beds with the new units, all those things. We actually will have about 56 to 58% of occupancy. What is sustainable ARPOB for us is about 48,000.
Yes.
And also kind of we expect it to grow about 6%.
6%. 6 to 7% is the ARPOB growth, and the rough occupancy that you're talking about is around 55 to around 56%.
Yeah, absolutely.
Got that. what about the margin trajectory? Well, what's the rough number? It's been all over the place yet again because of the changes, because of COVID. But a steady state, what is the rough number you look at?
So, what we've been growing is about our numbers, clinical numbers. Me being a doctor, I always look at the clinical numbers.
Yeah.
We've been growing at 17% clinical numbers. So, what we witnessed in the past is about 24-25% of the EBITDA, which is a pre-Ind AS. Now the new Ind AS standards about which adds rental also, about 30%.
And you have a big ambitious plan. From 1,600, I understand that you want to go all the way to around 2,500 beds.
Yeah.
So give us the geographic breakup. As of now, you're more south focused. How do you see that growth happening? And also, any inorganic growth on on your radar?
So now currently as we speak today, we are about 1,730 beds. So that includes a new spoke. And also we manage 130 beds in Delhi.
Yes.
That's a DDA managed beds. So what we plan to do is from the IPO to 5 years is 1,000 beds.
Okay.
So whatever the heroics, we have already done it.
Yes.
Because going to Bangalore, going to Chennai, going to the Delhi. So now the hub and spoke model is very well established in Hyderabad.
Yeah.
It's tracking well in Bangalore. And we want to replicate that same model in Chennai as well as NCR.
Okay.
So most of the beds are going in spokes.
Okay.
In Hyderabad, Bangalore, Chennai, as well as NCR.
So just let me get this right. You already have the hubs, now you're adding spokes to it.
We're adding spokes.
Okay.
And also strengthening the hubs also, because the Bangalore is getting nicely kind of shaped up now.
Yes.
We're adding more services in hub in Bangalore. As we move next 2-3 years time, the Chennai and New Delhi has to be kind of something like a Banjara Hills in Hyderabad.
And in the next 5 years, you'll be at around 2,600 beds?
Yes.
I believe that you also could be looking at inorganic growth, but you've not commented on that so far, Doctor. So tell us, is there something that you're looking at, say in NCR, Delhi region, or maybe in the western part of the country? Is that a possibility, inorganic growth?
No, absolutely. We are not kind of, we have a cash in the balance sheet.
Yes.
So when if there is a opportunities, how we see is like, the alignment is very important.
Yes.
We are children's health care. So philosophical alignment is very, very important, where we can add actually at the scale. So these two are important factors for us to kind of go and do any acquisition. So such opportunities comes, definitely we will be kind of looking at it, especially in kind of west,
Yes.
where our presence is not there.
So Doctor, the other important factor, as you mentioned, you'll have a cash surplus.
Yeah.
But what do you do with that is important. So give us a sense about your Capex plans. That's your maintenance Capex first up. And also, what do you plan on doing with this cash balance that you have? Could you quantify the updated number?
Okay. So we have the cash now of 450 crores, including the net proceeds for the expansions. So what we plan is about 1,000 beds next 5 years' time. So which would cost about 600 crores, maybe about over and about 50 crores to 100 crores.
Okay.
Plus maintenance capex about 200 outer limit 250 crores. So our net about 900 crores is the expenditure. So we will generate about 200 crores in a year.
Right.
So probably we'll kind of have about another 1,000 crores.
Okay.
So we will end up having about 500, 600 crores of a net cash.
If for some reason an inorganic growth doesn't work out, will the shareholders, could they expect some dividend payout, a healthy one? What is it? What has it been and what do you look to maintain it at?
So we have been giving a dividend for the last 10 years of 20%.
Of earnings?
Of earnings. So we, the last year also we have done the 20% of earnings. We'll continue to go. I mean, I think as the kind of a board will decide, whether it's 20% or more than that. So based on our capexes, based on our expenditures and those things, obviously, we need to respect our shareholders.
Yes.
So we have a lot of money.
So you look to maintain that dividend payout that you have been doing.
Another important thing is that, we have been asset light model all along.
Yes.
So therefore, we do need to build beds of our own.
As of now, out of the 1,550, 1,600 beds, what is the mix currently?
I think currently we have about 100 beds of our own.
Okay.
Which is in Visakhapatnam. I can add another 60 beds in Visakhapatnam in the same premises because it's a larger premises.
So around 10% is currently owned and the remainder is leased.
Yeah. If you ask me, the healthy mix probably about 30-35%. 5, 6, 7 years down the line is probably a healthier.
What about if you could give us a sense about the current shareholding? You had CDC that grew the business with you over the last few years. Now, when you all did their IPO, you took some money off the table and they as well. But they still have close to 15% stake in the company. What's their plan? Are they planning on, have they told you anything?
So they have a 14.9% stake still left. I think, I haven't heard anything from them yet.
Well, final question before we wind up then, Dr. Ramesh. You have told us how different the Rainbow is in comparison to the other hospitals that are there domestically as well. But what if someone gives you a big offer? Maybe a collaboration, maybe buying out a stake in your company, or maybe buying out the company itself, a larger hospital chain. Would you be game for it?
Okay, well, first of all, we built this Rainbow so passionately. It's just not me. It's built on many shoulders. It's a lot of our doctors. When we look at a Rainbow, it's I have still good 10 years to go to work very hard. Most of my doctors, I'm probably the oldest one in the group. So my doctors are very young. A lot of them have got a stake, and they are actually very, very managerial. And I have a son who is a 26-year-old. He's a pediatrician, so he's a bright kid as well. So Rainbow has got enough people to drive it for future and for a long term. So what I envisage for as a promoter of Rainbow Group, so I would like to see that Rainbow is there everywhere across the country, and it has to be bigger and brighter, offering a great quality health care for children.
On that optimistic note, well, it's been a pleasure talking to you, Dr. Ramesh.
Thank you very much.
Wishing you all the best in the times to come.
Great meeting you, Nigel. Thank you.
Okay, that was a deep dive into Rainbow Children's Medicare. Interesting inputs out there, but time to slip into a short break now. We'll come back with another interesting stock. SH Kelkar is in the Swotlight on the other side. Stay tuned. Welcome back. You're still tuned into Inside Out on CNBC-TV18, and on Swotlight today, we have SH Kelkar, which is a large domestic player in the flavor and fragrance market with the last known market share of 10 to 12%, that is in the flavor market, and close to 20% in the fragrance market. So basically, the products that the company makes is used as a raw material in many industries. Flavors are used in baked goods, dairy products, beverages, and pharma products as well. And fragrances are used in personal wash, there's fabric care, household products, skin and hair care as well. The company, for its own manufacturing, uses 1,500 products as your raw materials. The broader categories of these raw materials, out of which 50% are imported. In terms of financials now, they have been continuously growing in terms of revenues from around 1,050 crore rupees in FY19 all the way to around 1,600 crore rupees in FY22. However, margins have been coming down and are very volatile. After a sharp increase from FY19 levels from 13% to almost 18%, they are now back to those levels because of sharp hike in raw material prices. Profits as well have been impacted and are very volatile, as you can see on your screen. So financials are not very inspiring. The company gets 90% revenues from flavors and just 10% coming in from fragrance. In terms of geography, most revenues come in from India, around 21% each from Europe and rest of the world markets. This company is known for inorganic growth. They have made a lot of acquisitions in the past and will continue to do so as per the management. In FY22, they acquired Holland Aromatics BV and New Taste Food and Drink Private Limited to expand into newer markets. With New Taste Foods, they want to focus on QSR space, as according to the company, 2,000 crore worth of flavor and savory products going into QSR, and they are looking at a 200 crore worth of potential market from this, and from current levels of 12 crores currently, they plan to grow at a faster pace. Company usually takes annual price hikes, but due to COVID and volatility, they took price hikes twice last year. But they expect the normalized process to come back in place for price hikes. So one of their big trigger is a big request for proposal from a large global MNC, where the size of the proposal is $1 billion. out of which they say the potential is $100 million for the next 3 years, and they are targeting 20% share in the first RFP itself. But with triggers comes some risk as well. The company has sizable exposure to imports and Europe as well. So foreign currency volatility will definitely impact their financials. Yes, the Europe weakness could be near term, but it will impact their revenues. Also, debt of the company stands at 503 crore rupees in Q2, which has increased quarter on quarter due to acquisitions. So quick integration of all these acquisitions is important so as to not over-leverage the company. Company also came up with Q2 update today, where they spoke about inflationary pressures in Europe and impact of currency movement on profitability. They are taking price hikes to mitigate the impact of this pressure, especially witnessed in the European markets. Let's talk about shareholding now. Promoters hold 58.46% stake with some big names like IDFC FlexiCap, Tata Mutual Fund, there's Malabar India Fund, there's Harding International, India Inside being some big names. Blackstone recently exited SH Kelkar by selling its entire stake in the company at a massive premium to Farmank via a block deal. And in terms of valuations, stock trades at 16 times one-year forward earnings, but growth is something that the investors will be watching out for. And with that, we have run out of time on this episode of Inside Out. It's a goodbye from Nigel and I. But do write to us and tell us the companies you want us to discuss and you want to hear about. And we'll feature these on our show. Thanks a lot for watching.